Welcome to P2 Corporate Reporting. In this section, we are going to look at share-based payments in corporate reports. The standard that guides us when recording share-based payments in the financial statements is FRS 2. It was not examined in the F7 course, so we will go over it in this video. So let's begin. You're already familiar with shares, but how are they used to make payments? And then how can you record the transaction in the corporate reports? Okay, so what is a share-based payment? This is when the company pays for goods and services either with its shares or the payment amount is based on the value of their shares. This is what a share-based payment is, and there are three main types of them. The first is equity-settled share-based payment. This is exactly what it sounds like. Bills for goods and services paid by shares. You are likely to see this in directors' salaries, and where some or all are settled by share payments. This shows that key management have so much faith in the company that they are taking shares over cash for payment. These transactions are recorded as follows: debit, directors' salaries, X; credit, equity, X. Cash settled share-based payment. That is a bit of a mouthful, and it's also called share appreciation rights. This is when cash is received for goods and services, but that amount of cash is based on the share price. This means the value of the goods and services are decided by the share value. However, as you can see, no shares change hands, so the equity is unaffected. The recording journals are debit expense, credit liability. And finally, transactions with a choice of settlements. So cash or shares can be received for goods and services. When paying for goods and services with shares, it is a longer payment procedure than receiving cash. The shares need to be kept or sold. Sometimes these share agreements, particularly if they are payments in lieu of salary, have a vesting period. This means that they are not payable immediately, but in, say, a few years' time. So, for example, Manager X receives $30,000 of shares which are payable in 3 years. How are they recorded? The expense is spread over the 3 years. Once you have identified that it is a share-based payment and the type, you will record the payment in the financial statements. But how do you value it? There are two ways. The direct method, where the fair value of the goods and services are the value of the shares given. So, for example, a software developer accepts a share-based payment for 100 hours work. His normal rate is $200 an hour, so the fair value of his service is $20,000. This is the fair value. Debit software development, $20,000. Credit, equity, $20,000. Under IFRS 2, the direct method is recommended. However, if the fair value of the goods or services supplied cannot be measured reliably, we use the indirect method. The indirect method, where the fair value of the shares is used. When it's an equity settled situation, we use shares fair value at the date they are granted. When it's a cash settled situation, the fair value of the shares are updated each year. So, for example, if a director was paid cash based on the share value, they have a very strong incentive to grow the company and in turn the share value. Now, I said that IFRS 2 recommends we use the direct method. However, option 2 is more popular for the reason I described. Share-based payments are used to pay employees. And can you really reliably estimate the value of their work? As I said, employers often pay their employees in shares or give some bonus in shares. This is seen as a very good motivation tool as it aligns the employees' needs with the shareholders. Now, often as a retention tool, these shares won't vest for a few years. You know that their expense is spread over the vesting period. Let's do an example so you can see how it's recorded year on year. ABC Incorporated offers its 1,000 employees $101 ordinary shares for those who stay for the next 3 years. The fair value of each share option at 1 January year 1 is $100 each. They expect 100 employees to have left before the 3 years are up, and they will lose their rights to shares. In year 1, 50 employees leave, and management revised their original estimation to 200 employees will leave in the 3 years. In year 2, 75 employees leave, and management revised their original estimation to 150 employees will leave in 3 years. In year 3, 25 employees leave. How should these be recorded in the annual financial statements? We know that the employees will receive shares and not cash at the end of the vesting period. So, this is an equity-based payment. We can value these share-based payments directly or indirectly. As we have seen, employees tend to be valued indirectly. This means we used the fair value of the shares. The fair value is the market value. Now, this is a 3-year period, meaning that surely their fair value changes over this time. You're right, it probably does, but we don't need to worry about that. Why? Because we will use the fair value of the shares at the grant date, 1 January year 1, which is $100. We will use this valuation throughout the 3-year valuation period. Let's go through how we record this year by year in the financial statements. Year 1. Calculate the employees. 1,000 less the ones who leave minus the 200 who are expected to leave equals 750 employees. 750 multiplied by $100, the fair value of the share option equals $75,000. Now, the vesting period is 3 years, i.e. the shares don't pass to the employees until the 3 years are up. This 75,000 is for 3 years, so it is divided into 3 to get the year 1 cost. $75,000 divided by 3 equals $25,000. The journals are debit employee expenses $25,000, credit equity $25,000. Now, year 3. Calculate the employees entitled. 1,000 less 50 who leave in year 1 minus 75 who leave in year 2 less the 150 estimation equals 725. 725 multiplied by $100 equals $72,500. It's the second year, so $72,500 multiplied by 2/3 equals $48,333. This is for the 2 years. In year 1, we recognized $25,000. So this is deducted from 48,333 and the balance of 23,333. Debit employee expenses 23,333. Credit equity 23,333. In year 3, the scheme finishes and we record it as follows. First, calculate the employees entitled. 1,000 less 50 less 75 less 25 equals 850. 850 multiplied by $100 equals $85,000 is the cost for the 3 years. Deduct the amounts already recognized. $85,000 less $25,000 less $23,333 equals $36,667. Debit employee expenses. $36,667. Credit equity $36,667. Now, what if there is no market value? You will see this with startups where no certain market value can be identified because the shares are not sold on the open market, the company hasn't gone public yet, etc. This can be very attractive as employees will be able to sell their shares freely when the company floats on the stock exchange. But how are these share options valued on the stock exchange? IFRS 2 allows us to use the intrinsic value. What is that? This is when we take the current share price and take any amounts paid to enter the option. It's called the share price less the exercise price. Here we are going to assume that the share price is $10 and the employee pays nothing to exercise the option, so the value of the option is $10. This method of valuation is trickier, as the share value will need to be remeasured each year, making it very tricky, so uncommon. So now you know how to record shares that are granted to employees. How do we record share appreciation rights? As I said before, these are when companies pay cash for goods and services, and the price they pay is linked to the share price of the shares. So, although the share price dictates the amount paid, it is a cash transaction. And as with equity, there can be a vesting period for share appreciation rights. Let's look at the same example again, just with the share appreciation rights. ABC Incorporated offers its 1,000 employees 100 share appreciation rights for those who stay for the next 3 years. The fair value of each share appreciation right at 1 January year 1 is $100 each. They expect 100 employees to have left before the 3 years are up, and they will lose their appreciation rights. In year 1, 50 employees leave, and management revised their original estimation to 200 employees will leave in the 3 years. The fair value is now $110. In year 2, 75 employees leave, and the management revised their original estimation to 150 employees will leave in the 3 years. The fair value is now $120. In year 3, 25 employees leave. The fair value is now $115. How should these be recorded in the annual financial statements? Share appreciation rights are also called SARs. As you can see, their fair value is recalculated each year. At the end of the financial year 1, the SAR is reflected in the financial statements as follows. 1,000 minus 50 minus 200 multiplied by 100 multiplied by $100 equals $8.25 million. That is 1,000 employees less the 50 who leave the company less the further 200 who are expected to leave, multiply by the 100 SARs and the fair value. This is the value over the 3 years. We are only looking for the value in 1 year, so this is divided by 3. That is 2.75 million for year 1. The journals are debit employee salaries or bonuses, 2,750,000, and credit the liability, 2,750,000. Although we are settling this in cash, it is not due until year 3. Therefore, we must create a liability. Year 2. 1,000 minus 50 minus 75 minus 150 multiplied by 100 multiplied by $120 equals 8.7 million. This is for 3 years, and this is the second year of the scheme. So $8.7 million multiplied by 2 over 3, it's 2/3, equals 5.8 million. This is the fair value of 2 years. Now, let's deduct the expense already recognised in year 1. 5.8 million minus 2.75 million equals 3,050,000. The journals are debit employee salaries and bonuses, 3,050,000, credit liability, 3,050,000. And finally, year 3, when the scheme ends, is recorded as follows. Year 3, 1,000 minus 50 minus 75 minus 25 multiplied by 100 multiplied by $115 equals $9,775,000. This is for the 3 years. So $9,775,000 is the final expense. Deduct the prior 2 years already expensed. So 9.775 million less 5.8 million equals 3.975 million. The journals are debit employee salaries or bonuses, $3,975,000, credit liability, $3,975,000. At the end of the 3 years, the SAR is paid to the remaining employees. Its fair value is 9.775 million, as you calculated. Debit liability, 9,775,000, credit cash, 9,775,000. So, as you can see, there are many instances when there is a vesting period. But what determines this time? There are 2 types of vesting period. Non-market based. So, as you saw in the earlier videos, the share options were most likely to reduce the company's salary bill and encourage employee retention. The period was not determined by any rises in the share price. There can be other non-market conditions, such as increasing the company's sales by 20% in 3 years. The second type of vesting period is market-based. When we have a market-based vesting period, we must estimate when the condition will be satisfied. If the condition is satisfied in shorter time than the estimated time, we must expense the remainder of the amounts in the year that it was satisfied. Now, I am sure you are familiar with deadlines being missed. And what do we do if the condition is not satisfied in the vesting period, but will take longer? We expense the amount still using the original vesting period time. Now, what if you had 2 conditions for vesting, market-based and non-market-based? What would you do? When or how should they be recognised? If the party satisfies the non-market-based condition, e.g., they must stay for 5 years, and they do, the expense is recognised even if the market condition is not satisfied. So, for example, they must continue working with the company for 5 years and will receive share options when the share price has increased by 20%. Once the non-market-based vesting period is satisfied, the cost must be recognised, even if they don't satisfy the second market-based condition. When dealing with share-based payments, we are recognizing expenses long before they're actually paid. This is a difference between the company's taxable and accounting profit. In most jurisdictions, no tax deduction is allowed if the expense was not paid in the year. A tax deduction is allowed when the cost is incurred. Therefore, the taxable profits of companies with share-based payments is much different to their accounting profit. This is a timing difference. Once you hear the phrase timing difference, you should remember that tax assets and liabilities occur. In the situation of recognizing an expense in advance of receiving a tax deduction, gives us a deferred tax asset. Depending on the jurisdiction, the tax authorities may calculate the value of these share-based payments at their intrinsic value. This can result in a higher value for the tax asset. This extra deferred tax asset reduces the equity in the statement of financial position and is income in the OCI. Debit equity, credit OCI. The vesting period, as you can see, covers many years, and over years circumstances change, and the share-based payments could be modified in time. For example, the share options may be repriced to staff. Let's look at an example to understand how it works. Share Incorporated has a share option scheme where it will grant its 1,000 staff 100 share options at the end of 3 years. The fair value is $10. In year 1, 20 staff members leave, and a further 10 are expected to leave. In year 2, 30 staff leave, and another 5 are expected to leave. At the beginning of the year, the market value of the shares has fallen, and the fair value of the share options has dipped to $5. The management decide to reprice the share options. Prior to the repricing, the fair value was $5. Now they are worth $7. In year 3, 40 staff leave. How are these transactions reflected in the financial statements? The original option value was $10. Then their value dipped to $5. The company repriced them and the fair value increased to $7, i.e. $2, so 7 less $5. Okay, so what do we do? What value do we take? We use the original value and the increase in expense. So year 1's value was before the repricing. So it was 1,000 minus 20 minus 10 multiplied by $10 equals 9,700 divided by 3 equals $3,233. Debit expenses $3,233, credit equity $3,233. There is nothing new or strange here. We have done this before. Now, roll on year 2 and the share price drops and the options are repriced. How do we deal with this? First, calculate the staff. 1,000 minus 20 minus 30 minus 5 that are expected to leave. And then we multiply it by the initial $10 fair value and then the $2 increase. So 945 multiplied by 10 multiplied by 2/3 equals $6,300. And then 945 multiplied by 2 multiplied by 1 divided by 2 equals 945. The total for year 2 is 6,300 plus 945 less 3,233, which was from year 1, equals $4,012. The journals are the same as before. Debit expenses $4,012, credit equity $4,012. And finally, in year 3, 1,000 minus 20 minus 30 minus 40 multiplied by $10 plus $2 equals $10,920 less 3,233 less 3,600 which is recognised in the financial statements with the following journals: debit expenses 3,675, credit equity 3,675. So that's how you record the change in options value. What do you do if the company cancels the scheme? If the scheme is cancelled, often compensation is offered to those affected. Let's look at an example to understand how to recognise it. ABC Incorporated has a 3-year share option scheme where its 100 staff will receive 100 shares with a fair value of $100. In year 2, the scheme is cancelled when the fair value of the option was $50. To compensate their staff, they will pay them $60 per share. So in year 1, it is recorded as normal. 100 by 100 by $100 equals $1 million divided by 3 equals 333,333. Debit expenses 333,333. Credit equity 330,333. Year 2 is when the scheme is cancelled. We recognise the full cost in year 2. 100 by 100 by 100 is 1 million. In year 1, 333,333 was recognised. So it is deducted from the cost and $666,666 is expensed. Now, what about the compensation? It's $60 per share. So the cost to the company is 100 multiplied by 100 multiplied by $60 equals $600,000. When the scheme is cancelled, the fair value of the options is $50. And we now calculate their value. 100 multiplied by 100 multiplied by $50 equals $500,000. The compensation figure is higher than the fair value by $100,000. The fair value is treated like an equity buyback. So let's do that now. Debit equity $500,000, credit cash $500,000. The difference between the compensation and the fair value is then recognised in the P&L. 600,000 minus 500,000 equals 100,000. So what did you learn from that example? When you cancel share options, you do the following. 1. Expense the remainder of the fair value of the instrument. 2. Funds paid to compensate for this cancellation are treated like an equity buyback. And 3. If the compensation is more than the fair value, the amount must be recognised immediately in the income statement. This area of the syllabus is one that you need to practice. Questions can come from any section of share-based payments, and you must be familiar with it. Thank you.